What's going on? Alex here, and today we're going to answer the question, can ChatGPT do your taxes? With all the hype surrounding AI-powered tools like ChatGPT, the question is, can it replace your friendly neighborhood tax preparer? Well, maybe not so friendly sometimes, right? But we're going to put it to the test today, and we're going to get some answers. Now, just remember, this is not super scientific. This is all in good fun, but let's check out how we're going to get this done. What we've done is prepared a set of 9 tax questions. Now, these are made up questions. They're not found online anywhere. So theoretically, the software can't find the answer online and simply plug it in and call it a day. There needs to be some actual analysis involved in terms of the conceptual and the numerical outputs that these questions require. So we're going to start off easy. We're going to start off with some softball questions, and then we're going to get a little bit more advanced with a few scenarios, and we'll see how ChatGPT handles it. We're going to compare it to the tax software and see where we end up. I'm going to score each answer that we receive from 0 to 10, and we're going to get an average score when all's said and done to see if ChatGPT can do your taxes and potentially replace your tax preparer. As someone who's a CPA who's done thousands of tax returns, I think I'm in a good position to provide feedback on the answers that we get, if we get any answers. This is all being done live. I haven't done this before. I haven't run these questions through the software yet, so my reactions are going to be real time, and hopefully this works and we get some answers. Hopefully this isn't just an epic fail. And with no further ado, we're going to hop right into it. First question, if a taxpayer receives a gift in the amount of $1 million in tax year 2022, how much of that gift will be taxable? So this question is designed to evaluate if ChatGPT can differentiate between the treatment of a gift for federal income tax purposes and income. And it needs to know that gifts are not taxable to the recipient, assuming it's a bona fide gift and there aren't any shenanigans going on. But assuming all the boxes are checked for a bona fide gift, then it should not be taxable to the recipient. All right, so let's see what ChatGPT has to say about this. All right, so we're going to take this question. We're going to go over to this wonderful AI tool. We're going to plug it in, and let's see what happens. We're doing this in real time, so you guys are seeing it as I am. All right, so let's see if we get a response and then determine the quality of that response. Okay, all right, we're getting something here. All right, what does it say? Let's make sure you guys can see this. All right, so as of my knowledge cutoff in September 2021, all right, so we also have to keep in mind that ChatGPT has a limited knowledge of the world and events after 2021, but let's see how it does, because at the end of the day, most clients now have questions about 2022, so let's see how far we can get. As of my knowledge cutoff in September 2021, the federal gift tax rules apply to the person giving the gift rather than the person receiving the gift. The recipient of the gift generally does not have to report the gift as income or pay income tax on it. Okay, very good. Therefore, in the scenario you mentioned, the recipients do not owe any federal income tax on the $1 million gift for 2022. All right, that is as perfect an answer as it can get. All right, so we're gonna go ahead and give this a 10 out of 10. To start off, okay? Got to give credit where it's due. That is a perfect response, essentially. Okay, now we're going to test a different area. We're going to look at how ChatGPT deals with standard deduction amounts and if it understands that there are additional standard deduction amounts available for individuals over 65 years of age and who are blind. Those are the rules at the federal level. They allow additional standard deductions in those situations. So we're asking, what is the standard deduction amount for a 68-year-old individual who is blind for federal income tax purposes for tax year 2022? So it has to basically understand 3 things. So the standard deduction for tax year 2022, of which I believe there was information online as of the end of 2021 because the IRS releases inflation-adjusted figures beforehand. So it also has to know what the additional amount is for individuals over 65 years of age, and it also has to know what the additional standard deduction is for blind individuals. Okay, so let's take this question. Let's go ahead and give this a shot. Very good response in that first one. I'm impressed. Okay, so now we're going to give it the second question, and let's see what it says. Okay, so for tax year 2022, assuming the single filing status, The standard deduction amount for a 68-year-old individual who is blind is as follows. So the standard deduction for an individual who's 65 years or older or blind is higher than the standard deduction for younger individuals. The additional standard deduction for a single individual who's 65 years or older is $1,700. This is added on top of the standard deduction under 65 years of age. So it's saying for tax year 2022, the standard deduction amounts are as follows. For individuals under 65 and not blind, $12,950, and for individuals 65 or older or blind is $14,650, which is the original amount plus $1,700. Therefore, assuming the individual is 68 years old and blind, the standard deduction amount for federal income tax purposes for tax year 22 would be $14,650. Okay. To check this, we have here the instructions for the federal Form 1040. And as you can see, this is for tax year 2022. All right, just so you guys can see. All right, and we're going to go ahead and see what the instructions have to say regarding the standard deduction in this case. So let's go to page 34, and you see that there's a table here that says standard deduction chart for people who were born before January 2nd, 1958, or were blind. And we can see here that if you are using the single filing status, which we said we were, all right, and the number in the box above is 2. We're going to have 2 here because this person will be born before January 2nd, 1958, and we can calculate that as follows. 2022 minus 68, and we get 1954. So the person qualifies for the first checkbox, and they are blind. So the number above would be 2. So the standard deduction amount is going to be $16,450. So we're getting a different amount here. All right, so we have a $14,650. All right, and we can see here that the instructions for tax year 2022 are indicating that indeed it's going to be a different number. It's $16,450. All right, and I'm wondering why there's a discrepancy there. I'm not quite sure, but as you can see, it's saying that the additional amount for someone who is 65 years or older or blind is $1,700. And if we look at the instructions, we can see here that the difference is essentially the difference between $16,450 and then $14,700. So it's $1,750. So what's happening here is it looks like ChatGPT is still using 2021 amounts and applying it to 2022. That's the first issue. The second issue is that it's only taking the adjustment amount once. All right, there's 2 adjustments here. One for individuals who are 65 or older, and another one for individuals who are blind. In this case, we're hitting both of those scenarios, so that additional standard deduction amount should be applied twice, and that's what we're seeing here. All right, and let's take a look at the standard deduction amount for 2022. I believe it does have that correct, but let's take a look. All right, so standard deduction amount for 2022, as we can see here, is, let's get our tools here so we could see. All right, so for single filing status, it's $12,950. So did the software get that amount right? $12,950. Okay, so it got that amount right. The additional amounts that we're really testing for here, I didn't want just the standard deduction. I wanted these adjustments to be made correctly. Unfortunately, it kind of, the wheels fell off on that front. All right, so some good information, some not so good. So $12,950, let's just double check. $12,950. Okay, so we got some of the way there, but the real crucial aspects of that response were not met. So unfortunately, we're gonna have to call this a 4, all right, because we'd be way off on the standard deduction amount in this case. And it's also not recognizing that the additional amounts apply in both scenarios if they're both applicable, not just once. All right, moving along. Now we're gonna get a little bit more technical here, and now we're going to compare ChatGPT's response to the tax software, and we'll see what it does. And this is not so much a tax year specific question here, so let's see if it does better with that. If a taxpayer using the single filing status has $100,000 in wage income, $30,000 in interest income, $60,000 in self-employment income, and $40,000 of long-term capital losses for tax year 2022, how would the capital losses be treated for federal income tax purposes for tax year 2022? Please provide specific amounts as applicable. Now, those of you who watch this channel know what I'm testing for here. I'm looking to see if ChatGPT can recognize the treatment of capital losses, okay? You're only allowed to offset other income such as wages, interest, dividends, etc., with $3,000 of capital losses in a particular year. The rest of those losses are carried forward indefinitely to future tax years until they're either used up, $3,000 at a time per tax year, or they are used to offset capital gains. All right. So in this case, we're looking to see if ChatGPT can hone in on the capital loss treatment and properly identify how these amounts should be treated. We'll also compare it to what we have in the tax software. Okay, so question number 3, let's give it a go. All righty. It's thinking. Okay, let's take a look. So in tax year 2022, if a taxpayer using the single filing status has 100,000 in wages, so on and so forth, the capital losses will be treated as follows. Capital losses can be used to offset capital gains. Long-term capital losses can be used to offset long-term capital gains, so on and so forth. If there are no long-term capital gains, the taxpayer can carry the losses forward to future tax years to offset future gains. Very astute answer so far. Capital losses can be used to offset other income. If the capital losses exceed the capital gains, the taxpayer can use the excess losses to offset other types of income, such as wage income or self-employment income. For tax year 22, individuals can deduct up to $3,000 of capital losses against other types of income. Now, this $3,000 has been around a long time. It hasn't been inflation adjusted in decades, really. All right. In this case, if the $40,000 capital losses exceeds the capital gains, the taxpayer can deduct up to $3,000 of those losses against their other income. Okay. So let's see. So based on the information provided, let's calculate the taxable income. So now it's going above and beyond. I didn't really ask it for the taxable income, but let's see what it comes up with. So we have wages, interest, self-employment, total income. Okay. All right. Long-term capital losses. All right. And taxable income before capital losses. All right. Capital losses to get deducted against other income. Okay. And then taxable income after capital losses. All right. So let's see what we have in the tax software. But what I'm seeing here is there's no mention of the carry forward amount. And I asked it to provide specific amounts as applicable, right? Because clients have questions all the time saying, hey, if I have these capital gains, these capital losses, how's that going to play out? And really what we're looking for in this response is there's going to be X amount of capital losses that you can deduct this year and Y amount of capital loss carryovers that are deductible in a future tax year. And I'm not really seeing that spelled out here anywhere. Again, if you guys see it, let me know in the comments. But let's go to the tax software and see how this situation plays out. All right, so if we look at this tax return here, we could see that there should be some similarities to what we just discussed. Let me make sure you guys could see that. And here is where we're actually running this projection to calculate things such as taxable income, just in case it was going to give us those amounts. All right, so we have 100,000, we have the 3,000 loss, we have 60,000 coming from Schedule 1, which we will see here as the business income or self-employment income. And we have total income, 187,000. And then we have, it said the taxable income that it was calculating of 159,139. Let's see what taxable income ChatGPT showed. It showed 187. Okay, so 187,000 as opposed to 159. What difference is that? Okay, 159, 139. So 27,861. Okay, and we'd want to see where that difference is coming from, and part of it has to do with the fact that it's not taking into account the qualified business income deduction. All right, so let's see if that amount is factored in there. So 11193. Okay, so that leaves us with 16,668. Then we also have the, let's see here, deduction for the half of self-employment not being taken into account. So minus 3718. All right, and then 12,950. That's actually the standard deduction amount, and that's also not being taken into account here. All right, so if we take that, we get to 0. So it's not taking into account standard deduction, the fact that that amount affects taxable income. It's not taking into account the deduction for 1/2 of self-employment tax, which you're allowed to have, right? So if we go to Schedule SE, we can see here that this 3718 is a deduction for federal income tax purposes, which ChatGPT is not reflecting. Again, it's not tax software, but we wanted to ask it tax questions, and that's what we're doing. And we actually didn't ask it to calculate taxable income, which is interesting. So it's going above and beyond, but it's failing a little bit. And the other thing is it's not taking into account, let's see here, the qualified business income deduction or QBI deduction, so that 11,193 amount. The key thing that we were testing for here was that if we go to this general info area, we could see that there is a long-term capital loss carryover of 37,000. That's really what we were looking for here in terms of seeing if ChatGPT can work through the concepts of the capital loss deduction versus the carryover, and nowhere did it mention that amount. But as you can see, it was right in that you can deduct the 3,000 in 2022. So it was correct there, but every other amount basically is unfortunately incorrect. So we're going to have to dock some points for that. Let's see. What would you guys rate this response? I would probably give it right around 3. All right. So here we go. All right. Let's move on. And if you're enjoying this video, guys, if you find this interesting, like the video, subscribe to the channel, hit that notification bell, and leave some comments below with your questions. And let's see if we can see how ChatGPT responds, especially if they're tax questions. All right, let's try to keep it on topic. On to question 4. Assume that a taxpayer has an interest-only mortgage throughout tax year 2022 in the amount of $1,250,000, meaning the principal amount is $1,250,000, with an origination date of 7/15/2022. The taxpayer paid $30,000 in mortgage interest throughout tax year 2022. How much of the mortgage interest would be deductible for federal income tax purposes for tax year 2022? Assume the single filing status. What are we testing for here? Well, if you're familiar with the Tax Cuts and Jobs Act that was enacted right around the beginning of 2018, or a lot of it was effective as of the beginning of 2018, let's put it more accurately, you'll know that there were certain limitations put in place with regard to mortgage interest deductions, okay? And depending on when the mortgage is originated, you can either deduct interest on the principal amount of $750,000 or $1 million. And with the origination date of 7/15/2020, I would expect that the ChatGPT software would recognize that we're looking for $750,000 as the principal amount, not $1 million. So we're testing for that. We're also seeing if it can properly allocate for federal income tax purposes that interest amount, because some of that interest will be deductible, some of it will not. And we have a scenario built into the tax software that plays this out and gives us the amounts. So let's see how ChatGPT does. Okay, look at all this. Maybe I shouldn't say what I'm looking for beforehand. Maybe ChatGPT is listening. Who knows, right? This stuff is getting creepy these days, isn't it? Okay. The response is as follows. To determine the deductible amount of mortgage interest for federal income tax purposes for tax year 2022, several factors need to be considered. Let's see if any of these sound familiar. Mortgage interest deduction limit. There's a limit of the amount of mortgage debt eligible for mortgage interest deduction. The limit is $750,000. Look at that. That's exactly what we're talking about, right? So $750,000, hit the nail on the head. Perfect. Then it talks about grandfathered debt. Very good. So if the mortgage origination date is before December 16, 2017, it's considered grandfathered, and a higher limit of $1 million applies. Again, beautiful response, and that is true as well. But this debt does not qualify as grandfathered debt. Also astute observation. Based on the information provided, the taxpayer's interest-only mortgage. Why is interest-only important, guys? It's important because the principal amount is not changing throughout the year. Now, typically when you pay off a mortgage, there's the pay down of the principal over time, and that would mean that the average balance throughout the year would need to be considered to calculate the total deductible mortgage interest. So I wanted to keep it simple, straightforward, and call it interest only. That's why that's a distinguishing point. So the taxpayer's interest-only mortgage throughout tax year 2022 is in the amount of $1,250,000, which exceeds the limit. All right. So therefore, the deductible amount of mortgage interest for tax purposes will be limited to the interest paid on the first $750,000 of the mortgage debt. Totally true. Given that the taxpayer paid $30,000 in mortgage interest throughout tax year 2022, the deductible amount of mortgage interest would be $30,000, assuming that all the interest paid is attributable to the first $750,000 of mortgage debt. All right, so we kind of fell off the rails right at the end there. We almost got it, but then unfortunately lost it. So it's not typical that you have a mortgage of 1.25 million and you're just paying interest on a little piece of it. So in this case, it's saying that, well, that 30,000 would all be deductible, assuming it's just applicable to the first 750,000 of principal. That's not how mortgages work, unfortunately. So in this case, we have that 30,000 being applicable to 1.25 million of mortgage interest, mortgage principal. So this answer is absolutely wrong, unfortunately. Let's take a look at the tax software. All right, and we have this scenario playing out here. All right, and this is a very simple return, as you can see, single filing status, not much going on. But if we look at Schedule A, we'll see here that there's 18,000 as the deductible mortgage interest. And we have a worksheet that shows this off in a bit more detail. All right, so we have the ending balance and the beginning balance being the same because it's interest only, which gives us the average balance of 1.25 million. And this next page over here will show you the calculation. Basically, if you take 750,000 and you divide that by 1.25 million, all right, it's 60%. So 60% of the mortgage principal has interest that can be deducted associated with it. So in this case, we will multiply that by 30,000 and we get 18,000. So you'll see the interest deductible as home mortgage interest is 18,000. The excess is 12,000. That's not deductible for tax purposes. So that's why when you look at good old Schedule A, you'll see here that that is the deduction amount, not 30,000. So if you went with 30,000, you would have had an excess deduction in the amount of $12,000. So that is unfortunately not a good response, and we're going to have to pretty much call that a zero. Unfortunately, I mean, that's as good as a non-answer in our case. So a few more limitations that we're seeing, but the interesting thing to note is these mortgage limitations were in place in 2021. There isn't a big change for 2022, so it should have been able to catch that and get the correct answer. I was kind of expecting it to go a bit better, but it kind of fell off at the end. All right, so now we move on to question 5. And again, we're getting a little bit more technical, a little bit more advanced. I know that ChatGPT is not tax software. I realize that, but it should be able to navigate through some tax concepts if anybody's going to use it for tax purposes at any point, right? All right, so we see here that this question is as follows. Assume the following information for 2022. Filing status single, wage income 100,000, ordinary dividends 10,000, qualified dividends 5,000, loss from a publicly traded partnership 1,000. This is also known as a PTP, and taxpayers beginning basis in the publicly traded partnership 1,000. What are we testing for here? So partnerships have particular tax treatments associated with them, and even more so, you have publicly traded partnerships which have more restrictive rules associated with them. And we don't have to get too technical here, but the point is that if you have a loss from a publicly traded partnership, you need income from that publicly traded partnership, not another one, that particular one, to be able to deduct it. And if you don't have income from a PTP, then you're not going to be able to take the deduction. Even though I'm trying to throw it a curveball here, this is a red herring. Taxpayers' beginning basis in the publicly traded partnership is 1,000, which in many cases, if this wasn't a publicly traded partnership, if it was just a partnership, it may very well be the case that 1,000 could have been deductible, the loss, since there's enough beginning basis. But the PTP distinction is what we're testing for here. So let's take a look at what ChatGPT has to say. All right, so here we go. Okay, we're getting a response here. Okay, a lot of words coming in. This is why clients ask, why does it take so long to research tax questions? It's because there's never a quick question. All right, so here's the response. For tax year 2022, the treatment of losses from a publicly traded partnership, so it knows that we're keying in on that, for federal income tax purposes depends on several factors, including the taxpayer's basis and the type of loss incurred. Here's how the losses will be treated based on the information provided. So the basis is 1,000, all right? Passive activity loss limitation rules, okay? Those are the ones that are limiting the deductions from the PTP. So we have the treatment of losses from PTP depends on whether it is considered a passive activity for the taxpayer. If the taxpayer meets criteria for material participation, we're not getting there. We're not saying that that's the case. The losses may not be subject to the rules. All right, so then we have at-risk losses that it's explaining. Given the information provided, assuming the taxpayer did not materially participate in the PTP, which is the scenario we're going with, and did not have any additional basis increases throughout the year, the losses from the PTP would be subject to the passive activity loss rules and the at-risk loss rules. A lot of technical stuff, but let's see if it nails it here in this last paragraph. Based on the $1,000 loss from the PTP and assuming it is passive and subject to the at-risk loss, the deductible loss would be limited to the taxpayer's basis in the PTP. Therefore, the deductible loss would be limited to the beginning basis of $1,000. All right, so unfortunately, in this case, the ChatGPT software took the bait and unfortunately, I got this answer exactly wrong. All right, let's see how this would play out. Now, if we go to the tax software, okay, and the key point there was that it is indeed not deductible because you don't have income from PTP to deduct that amount. There, again, stringent rules there. So let's take a look. We have the PTP and we have this box checked off here. And we have here that there's a $1,000 loss and that there's a basis. Look at all these entries, all right? When you're doing K1s from partnerships, it can get crazy. We have the beginning basis of 1,000. So if we go to the software, to the return rather, and we take a look at Schedule E, we see that there's nothing there, all right? We have the PTP, but there are no actual deductible amounts here. Now, if we go to the worksheets, we can see that the basis limitation, all right, is applicable, but we also have the schedule of losses, right? So here, we could see that we have disallowed due to passive loss limitations 1,000, so that nothing hits the tax return, all right? Even though we have basis. That is the distinguishing point. It gets technical, guys. So this is important stuff. If you're a tax preparer, you have to know this. And these are questions that clients ask us on a fairly regular basis. So if we look at the 1040, we could see here that there is no deduction coming from Schedule E. On Schedule 1 or anything like that, right? So in this case, that loss has really no effect on the tax return, except if we look at general info here, we have unallowed PTP passive losses of 1,000, and also for AMT purposes, it would be applicable, and those carry over to 2023 in this case, okay? So that's a key point, and unfortunately, a lot of clients invest in these oil and gas partnerships, and they get caught up with deducting the losses, but they forget to check the box for the interest being that of a PTP. So not too high of a mark because ChatGPT is allowing the losses to be taken on the return when they indeed would not be deductible, all right? So let's just reread this, make sure we didn't miss anything. Based on $1,000 loss, deductible loss would be limited to the basis. Therefore, deductible loss would be limited to the beginning basis. That's incorrect. So we're gonna unfortunately have to give this a 0. And I see the question in the chat. It looks like it's ChatGPT 4. It's the latest one. I'm not sure. I just opened it up. Whatever version is available for free as of June 25th, 2023, that's the version I'm using. I'm seeing at the bottom here, it says ChatGPT May 24th version. So take that as you will. I believe it's ChatGPT 4. Okay. So that's a 0 for that. Hey, can't get them all. All right. Now we're going to test everybody's favorite type of stock option, incentive stock options, or ISOs. Now, ISOs are unique in that they have a different treatment for ordinary income tax purposes and for alternative minimum tax purposes, or AMT. And the main difference is that when you exercise an incentive stock option for ordinary income tax purposes, there really is not a tax event. Okay? It doesn't go on the tax return, doesn't affect the return at all, basically. But for alternative minimum tax purposes, the bargain element, which is the difference between the fair market value as of the date of the exercise versus the strike price for that incentive stock option, that is an adjustment for alternative minimum tax purposes. So it's essentially, you can call it income for alternative minimum tax purposes. So if you're subject to AMT, it could increase that tax for you. So if we look at the question here, let's just read it. Assume the following information for tax year 2022. Incentive stock option exercise or strike price, 10 cents. Number of incentive stock options or ISOs exercised, 10,000. Incentive stock option exercise date, 11/2/2022, so we're within the tax year, and fair market value of the stock at time of exercise is $10. So in terms of calculating the basis, because that's what we're asking for here, it says, what is the cost basis of the shares obtained through the exercise of incentive stock options for federal ordinary income tax purposes and alternative minimum tax purposes? So we're asking for the basis. So we have 10 cents as the exercise price times the number of ISOs exercised. So it's going to be 10,000. All right, so our basis for ordinary income tax purposes is really what we paid for those shares, which is $1,000 in this case, right? 10 cents times 10,000 shares. However, for AMT purposes, we are also including the bargain element. So it's the 10 cents plus the difference between 10 cents and $10. So really, for AMT tax purposes, we have $10 times 10,000 as the basis amount. All right, so those are the two basis amounts. So let's do it this way. We have 1,000 for ordinary income tax purposes as the basis and 100,000 for alternative minimum tax purposes. Let's see what ChatGPT has to say about all this. All right, we having fun here, guys? Let me know in the comments. All right, drop some likes, share the video, subscribe to the channel while we're getting this response. And we have our response here. All right, the cost basis of shares obtained through the exercise of incentive stock options for federal income tax and alternative minimum tax purposes is calculated differently. Very good. Let's break down the calculation. For federal ordinary income tax purposes, the cost basis of the shares obtained through the exercise of ISOs is the exercise price paid for the shares. We just talked about that. Perfect. In this case, the exercise price is 10 cents per share. Therefore, the cost basis would be calculated as follows. Look at that, $1,000. And what did we have? $1,000. Okay, A+ so far. Let's see if it understands the difference for AMT purposes. So for alternative minimum tax purposes, the cost basis of the shares obtained through the exercise of ISOs for AMT purposes is the fair market value of the stock at the time of exercise. In this case, the fair market value is $10 per share. Therefore, the cost basis would be calculated as follows. Look at that, 100,000. Okay. Well, that is an A+ right there. That is a perfect response. That's exactly what we're going for. And that's correct as it can be. All right. So anybody guessing a grade 10, you got it. All right. Pretty good. I'm really impressed with how detailed that was. And I kind of wasn't expecting to get that one. All right. So now we have another question. We have only 9 questions, so we're getting to the end of this thing here. And this question is pertaining to S corporations and their owners. So it says, assume the following information pertaining to an S corp and its sole shareholder/employee for tax year 2022. LLC was formed in March 1st of 2022, and you can make an S election for an LLC and have it taxed as an S corporation. So the S corporation election effective date was 3/1/2022. So the first day. Very common. Beginning shareholder stock basis is 100,000, additional shareholder contribution 20,000, S corporation losses 220,000, and then S corporation distributions of 70,000. We want to know, what is the income tax effect of the above mentioned items for the sole shareholder/employee for federal income tax purposes for tax year 2022? Also, what is the shareholder's basis as of the end of tax year 2022? Please provide specific amounts. Now, we're getting more advanced. We're testing if it understands how the calculation for an S corporation shareholder works and how the losses work with regard to what can be deducted, what can't be deducted, what is carried forward, and so forth. Because there are limitations on all of this stuff in terms of how much you can deduct in a particular tax year. All right, so let's see what ChatGPT has to say. And we have this modeled in the tax software here. All right, so all of this goodness is coming up. All right. Look at this. See, there are no quick answers in taxes. It's thinking. Okay. All right. Comes out with something. All right. Okay. Wow. This is quite a book that it wrote. Well, let's see what we have. Like the video if you guys are still sticking around, would you? Appreciate it. All right. So based on the information provided for 2022, let's determine the income tax effect for the sole shareholder employee and calculate the shareholder's basis. So the income tax effect, shareholder stock basis. So beginning, additional, total 120. So 100 plus 20 is 120. And then we have the losses is 220. All right, so S corporation losses flow through to the shareholder's individual's tax return. Okay, however, the deductibility of losses is subject to various limitations such as basis and at-risk rules. In this case, assuming the shareholder has sufficient basis. I don't know why we would have to assume that because we determined that here, but let's take a look. The full $220,000 S corporation loss would be deductible. So now we have the losses, now we have the distributions. S corporation distributions by the shareholder are typically tax-free to the extent of basis. Okay. In this case, assuming the shareholder has sufficient basis, the $70,000 S corp distribution would be tax-free. Okay. Net income tax effect. So we have deductible losses minus tax-free distribution. So the net income tax effect is $150,000. Net income tax effect isn't really a standard term that's used in the income tax world, so I'm not sure exactly what it's referring to there. There's adjusted gross income, there's taxable income, there's total income, but net income tax effect is kind of a nebulous term. So therefore, the income tax effect for the sole shareholder employee of the S corporation for tax year 2022 would result in a net taxable income of $150,000. Okay, that's interesting. All right, so shareholders' basis as of the end of the year, let's just get to the bottom of this. It's going to be $270,000. All right, that one is an interesting one. I'm not sure how it's getting these numbers, but let's take a look at the tax software and see what I came up with, and hopefully that's correct. All right, so here we're playing out this situation, and we're making the assumptions that it's just the K1 flow-through amounts that are applicable to this S corporation shareholder. So there are no wages to take into account for the time being. It's just those amounts that we discussed. And this is the S corporation shareholder stock and debt basis limitations report or worksheet. It used to be a worksheet. Now it's an actual tax filing that you have to include with your personal return. But we see here shareholder stock basis and how it's calculated. So stock basis at the beginning of the year is $100,000. All right, which let's just make sure matches our handy dandy spreadsheet. Yes. All right. So now we have contributions, which increase the basis, right? 20,000. All right. So now we're at 120. The important thing to take into account here is now distributions are reducing basis before losses, because as ChatGPT astutely pointed out here, you have tax-free distributions only to the point at which you have basis. But if losses take your basis down to zero and then you have distributions, those might be taxable. So the tax code is actually gracious in the respect that it allows you to take your stock basis, reduce it first by the distributions to avoid those taxable scenarios, then it will allow you to apply the losses. And that's what's happening here on 7203. So we have 70,000 distributions. So we have stock basis after distributions of 50,000. With that, we have the allowable loss and deductible items of 50,000, because as an S Corp shareholder, your basis is 50,000 after these amounts that we talked about. You can only deduct 50,000 in losses. This is another thing that people always forget about. The deductible loss in this case is 50,000. So if we look at Schedule E, we should see 50,000, okay? And it's also going to be on Schedule 1, 50,000. This is from S corporations, right? So it's flowing through from Schedule E. And then going to the 1040, we do have that 50,000, and it is creating a net operating loss because there's no other income factored into this tax return. It's all losses from the S corp. So we have net operating loss of 50,000, and then the basis losses are 170,000, right? Because we're deducting 50,000 of the 220. Okay, 220 is right here. We're deducting 50,000 of that to offset other income or to create a net operating loss in 2022. The rest of it being the 170,000. So 220, okay, minus 50,000 is giving us 170,000. All right, and that is what's being carried over to the following tax year. These are all the carryovers that we're dealing with here. So if there was other income, there wouldn't be this net operating loss. It would be used to offset wages, probably from the payroll from the S corporation, interest, dividends, things like that. So it likely wouldn't be a carryover if there was other income. I just wanted to hone in on this scenario and keep the facts straightforward and simple. So let's go back and see what the rating is for this response. It was very verbose, very long, and it did nail some of these amounts, talking about the stockholder basis and the fact that there were the losses there. But it fell off the rails here. So this net income tax effect, I'm not sure what that is. That's not a figure that goes on any sort of tax return. And the net taxable income of $150,000 is very wrong. So looking at this 1040, the taxable income is zero, right? Because you don't have any income and we only have losses. So the grade that I would give this response, and chime in you guys in the comments. I want to see what you would rate this response. Net taxable income is off by $150,000. I would have to rate that pretty low. And let's see here. At the end of 2022, the shareholders' basis in the S corporation will be $270,000. Absolutely not. Let's take a look. If we go to 7203, we see that the stock basis at the end of the year is zero. So we're off by $270,000. All right. I have to give this a 1, guys. What do you think? Is that fair? Am I being too harsh? All right. It didn't nail the taxable income. It was off by $150,000, and the shareholder basis is off by $270,000. So it's falling for all of my traps that I set. But, you know, when AI takes over and it becomes our overlord in the future, none of this is going to matter anyhow, right? So we're having fun here, guys. Don't take it too seriously, all right? But, okay, I see that somebody would rate it a 3. You can't have, if you have a client that you tell them their net taxable income is going to be off by $150,000 and their basis is off by $270,000, they're going to go nuts. Okay. So this definitely would not work. And hopefully nobody would put this on their tax return. All right. Getting to the end of this. If you guys are enjoying this, like the video, subscribe to the channel, leave a comment. I see that there are a lot of comments. I'm going to try to get through them as quickly as possible at the end here. So let's keep those comments coming, if you would, please. All right, so this next question is a bit more open-ended, and I wanted to see how ChatGPT can navigate a common question that us tax professionals get, which has to do with self-employed individuals and the different retirement plan options that they have available. What amounts can they contribute? How does all that work, right? Someone's a freelancer, they're an independent contractor. They just started many times, and they don't know how all these amounts come together, and we are often asked to help with these sorts of questions. Let's take a look. Assume the following information for 2022. Filing status, single, you know how, it's common thread here. And net self-employment income on Schedule C is $125,000. Now, the question, what are the taxpayer's options in terms of retirement plan contributions for tax year 2022, assuming that the taxpayer was not covered by any other retirement plans throughout the year, because that can change what you're eligible for in terms of retirement plan contributions. Please provide specific account types and contribution limits as applicable. And as I asked the question, guys, fire away in terms of what you think the grade is going to be. What are your predictions? Come on, we're having fun here. All right, so let's go here and ask this question. Okay. All right. This is kind of tricky because there are many different options and there are some calculations necessary to determine what the amounts would be. Okay. All right, so we're getting a lot of different possibilities here. Okay, and we have a scenario where we could run some of these possibilities and see what we get. All righty, so let's leave this and let's pull this up and we can play along. All right, now let's see what ChatGPT said here. And feel free to fire away with your predictions for what grade this answer is going to get. For tax year 2022, a taxpayer who has net self-employment income has several retirement plan options available to them. The options include individual retirement accounts, yes, self-employment and self-employed retirement accounts. Here are potential options with regard with their corresponding contribution limits. So traditional IRA, taxpayer can contribute to a traditional IRA, which allows for tax-deferred growth. The contribution limit for 2022 is $6,000, and it goes into the adjusted amounts for individuals age 50 and older. Okay. Roth IRA, also an option. Contribution limit is $6,000 for 2022. Okay. Then it's talking about self-employed pension or SEP accounts, and it provides the limits for a solo 401k. It says the maximum contribution is $58,000. What I'm seeing here is that it's not actually giving the taxpayer solid contribution amounts for the SEP. For the solo 401k, it's saying you have this available. Here's the maximum. But the next question is going to be, well, I get the maximum. What amount can I actually contribute? Let's see if we can ask it that question. It's still giving us the generic maximum amount. I know it's not a tax software, but I'm still trying to push it. Okay. All right, so it's telling us a bunch of numbers here. Okay. All right, so we have here the total amounts, total contribution. Okay, so I think we finally got it. So in this case, for an individual under the age of 50, because there are catch-up contributions with a net self-employment income of $125,000, the total maximum contribution to a solo 401k would be, so let's see, so 19,500 plus 31,250, the total is 50,750. Therefore, for a self-employed taxpayer with 125,000 net self-employment income, the maximum contribution to a solo 401k will be 50,750. Let's test that out. Let's go into the software and we're going to make it calculate the maximum contribution amounts for the solo 401k. So you have the profit sharing element and you also have the salary deferral or elective deferral element. Okay, so you have the profit sharing, you have the solo 401k elective deferral amount. So we're putting one here to determine the maximum. All right, so let's go to the tax software. And this is an extremely common question that tax professionals get. All right, so we have 125,000 net self-employment income. You can see that right here on Schedule C. And if we look at the Schedule 1, we should be able to see here self-employed and simple qualified plans. And here is the worksheet, okay? So here it's basically giving us the answer that we were looking for. Let me make it so you guys could see this. All right. And you can see here that there are different amounts that play into this calculation. And you can see here the full thing. Important to note, the net profit for self-employment, now you have to adjust it for the deductible portion of self-employment tax and so forth, and then you have to kind of run through the numbers here. But you could see something here, and that is that the allowable elective deferrals are $20,500. The maximum contribution here for both the salary deferral and the elective deferral and the profit sharing is $43,734. All right, and what did we get as the answer for this amount? We got 50,750. All right, so let's take this piece by piece. So part of this is 19,500. That's the 2021 amount, if I'm not mistaken. And it's not giving us the 2022 adjusted amount of 20,500. So that's one issue there. And on top of that, let's see. So this 31,250 unfortunately is incorrect. That's the profit sharing portion, okay? So we can calculate the profit sharing portion by taking the total, so 43,734 minus the 20,500, and we get 23,234, okay? That's the maximum this particular taxpayer can contribute as the profit sharing contribution. And you add to that the elective deferral amount, so 20,500, you get 43,734. All right, and you can see how this calculation plays out here. All right, another option that was mentioned so just to summarize, that amount unfortunately is incorrect. Now, the other option that was mentioned was a straight up IRA contribution, right? So you open an IRA account and you contribute the maximum amount, which it did get correct, was $6,000 for 2022. All right, so IRA deduction worksheet, you have the maximum is $6,000. It also shows you the $7,000 if you're age 50 or older contribution amount, which is also important. And you also would get to deduct it assuming you have enough income. So in that case, that part of the answer is correct. All right. So it's talking about way up here, the IRA amount. Let's see. Okay. This is a few responses ago. So 6,000 and then age 50 or older, 7,000. So that is astute. All right. And then kind of falls off the rails when we ask it about the 401k. That's a little bit more tricky. We have to apply a grade here. Okay, so one of you predicted that the grade would be 6. I'm gonna put this at a 3. It talked a lot of game, but at the end of it, it didn't really get the job done. Now, final question, guys. If you guys are still sticking around, like the video, subscribe to the channel, and do all that YouTube-y good stuff, will ya? Because this is a beautiful thing that we're here together talking about some taxes, right? And before we go to the last question, put your prediction in terms of what the grade is going to be in the comments, would you? All right, we're having fun here. I love this. All right, so now we're going to get into a pretty technical question. This has to do with correcting depreciation that was not done correctly. There's a whole process. It's very tedious in terms of how this can be adjusted. And I want to see if ChatGPT even has an idea in this case of how to approach this, because this is a fairly difficult question for many people to address. Let's see how it does. And for reference, the question is as follows. A taxpayer failed to deduct depreciation for 2 rental properties for the last consecutive tax years, last 5 tax years. One of the properties was sold throughout tax year 2022, and the other continues to be held as a rental property. That's a key point. Would the filing of Form 3115, which we have here, and this is an application for change in accounting method. It's a fairly involved beast of a form. Hopefully you never have to deal with it. Now, I'm asking, would the filing of 3115 be required in this case? And if so, what DCNs, or these are designated change numbers, all right, would be necessary? These are codes to tell the IRS what changes we're making, all right? And you can find a whole list of codes in the instructions for 3115, right? They talk about all these different codes, and there's probably more than 100 of them. But you need to know the specific code that you're using in a particular situation. Otherwise, you're going to file the form incorrectly. So let's see what ChatGPT has to say about the final question. All right, I see the predictions here for the grades. I see 0 and 2. Hopefully, let's have faith, guys. Come on. All right, so this is the last question. As it's typing here for us, oh, it's thinking a while. It's a tough one. Oh, no. Okay, so I'm already seeing some bad news here. You guys might be on point with your predictions. All right, I'm sorry, but I cannot provide specific form numbers or DCNs for IRS forms as they change over time and are subject to updates by the IRS. You know, as a tax professional, I'm going to start telling clients the same thing. I'm sorry, I can't tell you the answer. It keeps changing. Every time I look at it, it's different. However, I can provide some general guidance. All right, so 3115 is the form for change in accounting method. Okay, you can catch up adjustment for missed depreciation for prior years. Catch up allows to claim the missed depreciation. Okay. When completing Form 3115, taxpayer should include the appropriate section and part related to the depreciation adjustment, so on and so forth. It's not really getting us there, okay? It's giving us some general information, which is nice, but at the end of the day, the DCNs are necessary to complete the form. So it kind of fell off the rails here. I knew this was going to be more of a technical question because you have to read a lot of information to get the answer, but in this case, it didn't get it. The answers I was looking for were, in this case, were 7 as one of the DCNs, and the other one is going to be 107, okay? As you can see, there are a lot of these codes, all right? But specifically, 107 has to do with the item of depreciable or amortizable property that has been disposed of by the applicant and for which the applicant did not take into account any depreciation allowance or did take into account some depreciation but less than the depreciation allowable, going from an impermissible method of accounting to a permissible method, okay? That 107 provision would apply to the first property that was sold, okay? So one of the properties that was sold, it did not take any depreciation and it was disposed of throughout the year. So in that case, you would use DCN 107. In the other scenario, you would use DCN 7. This is for the property that continued to be held as a rental property. It was not disposed of throughout the year, so you can't use 107. You have to use 7. And this change goes from an impermissible method to a permissible method. And basically, that's for a property that you're still holding that you want to basically catch up the depreciation for. All right? So 7 and 107 were what we were looking for. In this case, we got a bunch of information, and basically the software is saying that it can't give us the answer. I don't know, guys. Should we give it a 1 or should we give it a 0? In this case, it doesn't really get us there. We'd have to continue searching or find out how to deal with this, but it doesn't really help us get the form done. So unfortunately, guys, I'm going to have to give this one a 0. All right, so let me save this for good karma, and let's see what we have here. Let's just make sure that we filled out all of these scores here. So it did really well with the gift tax question, nailed it, and then it kind of fell off the rails in terms of any specific tax calculations. Again, guys, I realize ChatGPT is not tax software. I get it, but I'm still curious about whether it can understand certain concepts and communicate basic calculations, because some of these things don't really change drastically from year to year. All right, so going to the mortgage question, unfortunately, it missed that one completely, right? You guys remember. The PTP question was totally off. Then we had the shareholder basis and losses question that had some meat on it, but not too much. And the self-employment question was a 3. And finally, we have the DCN question, which I thought was going to be a little bit tough, but we didn't get any closer to finding an answer there. So with these grades out of 10, we have an average score after 9 questions of a 3.4. All right. So I would say that our jobs as tax professionals are still secure. We still are top of the pack in terms of not having AI eat our lunches today, but maybe ChatGPT 5 will render us all completely useless. I don't know. I'm rather optimistic about this technology. I think it's amazing what it can do. And I'm certainly not one of these people who is naysaying technology just for the sake of it. I think there's a lot of promise in it, and I'm really excited about it. So with that, guys, if you like this video, if you found this engaging and interesting, subscribe to the channel, hit that like button, hit that notification bell, and just know that Efros Financial offers a full suite of accounting, bookkeeping, financial plan, and tax services for your business and for the personal side of things, all right? So we'll help you answer all of the tax questions that ChatGPT cannot, all right? So with that, I hope this was helpful. Let's take a look at some of the comments here. Someone said precise verbiage seems to make a difference. Right, so I mean, you can try asking the same question 15 times, but if you get 15 different answers, how can you know which one's the accurate one, even if you change your wording, right? It could be the fourth one, could be the last one. Someone mentioned here, accounting strategies and methods are a nightmare for accountants. I can only imagine how complex it is for ChatGPT. Yeah, it's a matter of blending the technical number side with some conceptual understanding as well. That's really what tax is all about, right? You can't just read the instructions and be able to complete a tax return. There's a lot that goes into it in terms of understanding how people put the numbers together, where the numbers are coming from, and whether you have to separate an amount into 2 values or whether it just stay 1. So an example is someone will have a business where they made $150,000 and they'll have $300,000 in miscellaneous expenses. Now, if you ask ChatGPT what the net income is, it'll spit out a net income number very likely, or actually, if you take today's lesson into account, it's not going to happen, but it'll spit out a number, and it's not going to take into account that miscellaneous expense amount may be wildly incorrect, right? If you look at it, there might be personal expenses in there, might be a lot of things that should be in a different category altogether, or they may even need to be capitalized, which is not going to allow you a deduction at all in the current tax year, or a much smaller one. That is really what tax is all about. And unfortunately, it's not just about a yes or no. And sometimes it's not just black and white, right? There's a lot of minutia that goes into it, a lot of nuance. All right. Thank you for your question. Now, we have another question here. Are losses in S-Corp considered distributions for the shareholders? They are not. Okay, so if we look at this scenario here, you should see that, let's see, this was which scenario? We'll get to it right now. Okay, this was, all right. And let's open that up. You'll see that they're actually treated separately. So losses and distributions affect basis, but distributions and losses are functionally different. All right. So if we look at 7203, you'll see here in our scenario that there was 100,000 in stock basis. Then we added 20,000. The distributions reduce basis, but if this taxpayer took the 70,000 out of the S-Corp, it's not going to change, in this case, their tax situation. Let me share my screen. The tax situation in tax year 2022, okay? But the losses are what is going to end up on the tax return. So the thing is, you have the buffer of distributions, which are going to limit the amount of losses that you take, but they're functionally different. The losses reduce your taxable income, which actually reduce the amount of tax that you pay in a particular year, okay? According to the tax rate, not dollar for dollar. So losses are crucial in that respect. Distributions are different in that they're just amounts that the S-Corp owner took out of the S-Corporation that aren't salary. They just wrote a check to themselves or transferred funds from the business account to the personal account. So in that sense, it does not create a deductible amount. It does not create a deduction for the S-Corp, and it does not reduce the tax amount that the taxpayer is paying. It's simply a transfer of funds, essentially. But losses do reduce taxable income, and it's important to understand whether you can deduct the full $220,000 or some fraction of that after you apply the basis limitation, the at-risk limitation, all these other things. This stuff can get real complicated very quickly, all right? There's another question here. I guess the better question I would have is the following. Is there any scenario in which the loss can cause a capital gain for distributions in excess of basis or are the distributions the only way? So as you can see here, the tax code is such that it's a bit taxpayer friendly, believe it or not, because the shareholder basis is not first being reduced by the losses. First, you reduce it by distributions. Then you factor in the losses, all right? This is friendly in that it prevents a small amount of distributions in resulting in a capital gain for the shareholder. So you're asking if losses can create a capital gain for distributions on an excess basis. It cannot, really. There may be some strange scenario where that happens, but the rules are set up to prevent that particular event from occurring. So you take the distributions. Now, let's remember, if your distributions exceed your basis, you're going to have a taxable event anyhow, right? Because the losses don't even factor in at that case. But if assuming your distributions are less than your basis, then the losses are taken into account after the fact, and you shouldn't have any capital gains on those distributions at the shareholder level. Guys, thank you so much for tuning in and watching. I appreciate it. You guys are absolutely amazing. Thank you for your questions, your comments, for tuning in and so forth. If you liked the video, smash that like button, subscribe to the channel, hit that bell icon to be notified of future videos, because you know there will be. And if you ask an interesting question in the comments, I might just answer it in a video just like this one. Again, Efros Financial, full suite of accounting, bookkeeping, personal finance, financial planning services. So if you need help in any of those areas, feel free to drop us a line. The contact information is in the description. All right. And with that, hopefully this was helpful. Thanks for watching.